Carl, thanks for joining us.
Good to be here.
As you're traveling around speaking with clients, what's the number one question you're being asked these days?
By far, the number one inquiry that I receive is whether the Federal Reserve's low for long interest rate policy has gone on for too long. And the concern centers on more than just the fact that interest rates are very low and so investors aren't getting a lot of return. The concern continues along to wonder, going forward, whether all of the liquidity that the Fed has put into the system might create inflation or kindle another round of asset bubbles that would destabilize the financial markets. In addition, at some point, the Federal Reserve is going to have to reverse course and slow and then ultimately reverse the quantitative easing program. And there's concern that if that is not handled well, that you could see a relatively rapid rise in interest rates that would be particularly damaging to financial markets.
What might the Federal Reserve do to avoid negative unintended consequences?
The Federal Reserve has been thinking about its exit strategy for a number of years, and they have some strategies that hopefully will prevent some of the poor side effects from occurring. First, about half of the reserves that they have put into the banking system remain on bank balance sheets unlent, and so they have strategies to keep them there by offering banks higher interest rates to hold those reserves as opposed to lending them out. Secondly, in order to avoid asset bubbles, the Federal Reserve can, through its supervision, require additional capital for certain types of asset classes and through their supervisory messaging, initiate a series of concerns or raise a series of concerns with the banks who may be contributing to the asset price excesses. And on inflation, of course, the Fed has a pretty good track record of keeping things in check. And so while none of this has been tested to this larger scale, I remain optimistic that the exit strategy, when it comes, will be a relative success.
So that would be a best case scenario on how this plays out. What's the risk here? What do you see as the possible worst case scenario?
The worst case scenario would be one in which inflation does become unmoored and skies above 2%, or we do start seeing bubbles develop in some markets. Because the Fed has a mandate to control prices and to secure financial stability, those scenarios would find them having to begin removing their ease before they're really ready and before the economy has fully recovered. In that event, we could be left with high levels of unemployment, market performance that's poor, and a central bank that no longer is in a position to help. Hopefully, however, through the measures that the Fed is taking to monitor all of these things, that scenario will be a remote one.
Well, thanks very much.
Thank you.
Thank you for listening. For more insights from our economic research team, visit northerntrust.com/view.